Hello everyone, welcome back to the channel. I'm a 21-year-old investor looking to compound my wealth in the stock market. So in today's episode, I'll be covering whether or not Google is a sell today, as well as exploring other opportunities outside of Google that I'm looking at right now. So this is my portfolio. It's my portfolio without my cash position. And as you can see over here, I'm not sure if you can see it, but Google is this chunk here, which is around 16.3% of my entire non-cash portfolio today. So it's a substantial position in my entire portfolio. So I'll be evaluating whether or not to sell this position today. So from a valuation standpoint, the company now is trading at a 30 times EV to EBIT. So if you were to compare this to all your different other Max 7 companies, like for example, Amazon, Microsoft, Apple, as well as Meta, the stock is currently not the most expensive, but it is on par with other companies in this space. So for example, Microsoft is actually trading at a 26 times EV to EBIT, whereas Google is trading at a 30 times EV to EBIT. So Google is certainly not cheap. In April this year, it traded down to around a 13 times EV to EBIT. So now that it's at around a 30 times, it is around a double. It is more than a double from its lows this year. So for Google, this was actually what I wrote in my Telegram channel. I was discussing whether or not to sell Google on there. So this is what I said. I said, nothing much, having some thoughts on Google. Google is currently trading at a 30 times EV to EBIT. P ratio is suppressed because of non-recurring investment gains. So analysts are projecting around 6% EPS growth next year due to this year's inflated earnings because of the investment gains. So if there wasn't any investment gains, Google's price to NOPAT is actually closer to around a 35 times of earnings. So the thing about Google is that qualitatively, the company is great. So YouTube will do even better next quarter. They just introduced some new banner ads, something like this. So they now have this ads on the side when you're maximizing your screen on your phone. It's a new way for the company to monetize and increase their earnings. And besides that, Gemini is also Google's way of challenging OpenAI. So this is purely anecdotal, but I have Gemini Pro. It's not too bad. It is almost on par with ChatGPT, and they gave out a free subscription of 1 year. That's why I have it on Pro on Gemini here. And besides that, ad market is projected to grow at around 14% over the next few years, all the way until 2032. So all great, but valuation today is a lot higher than what it was a few weeks ago, a few months ago. So a few months ago, most analysts had an exit multiple of around 25 times. Now it's closer to around 30 times. So with higher valuation, what that means is your future expected returns will be lower. And besides that, expectation is also higher. So a way for you to think about it is to think in terms of earnings yield. So for example, let's say if Google is currently at a 35 times of earnings, then what that means is that its earnings yield is around 2.9%. So 2.9% of earnings yield. So if you want to get around 15% return, Google has to grow at around 13%, assuming that earnings yield remains unchanged over the next few years. So a few considerations here. Search is still a substantial portion of the entire operating income chunk. I'll get to this later. Can search grow at 15% for the next few years to justify today's valuation? So last year we had the election. That's why Google search accelerated last year. This year we have had nothing, mostly Google's innovation driving their AI overviews and so on. Next year we have an event also. We have the World Cup in the US that could drive up ad revenue in the US itself. And the other concern is, what are the chances of OpenAI introducing ads? So if you didn't know, OpenAI has a target of hitting, I believe, $100 billion of revenue over the next few years. And they're currently at around 13 billion. So there really is no way for them to do so unless they introduce ads on their platform. They're currently not doing that because Gemini is pushing very hard. It's offering free usage to university students like myself. So that's why OpenAI isn't introducing ads yet, because they will lose share if they do so. They're sort of like in an oligopolistic position with Gemini, and Gemini is Google's way of fighting back. But in the future, OpenAI will probably introduce ads. OpenAI will make ChatGPT turn into an everything app. That's what they're already doing today. So I know there are ads in Amazon, I know there are ads in Meta already, but those are not direct competition to Google search. Google search main competitor will still be your LLMs, your ChatGPT bots, and so on. So to the first point, it says possible but variable given ads are always leading and tied to economic conditions. But then again, there are major events coming up, like next year you have your US World Cup, and so growth is probably still likely. We just don't know the extent of it. Next one is in response to OpenAI's bot and ads. So in the future, you have a few things coming up. You will have OpenAI introducing ads for sure. There's no other way for them to get to their revenue goal. And a lot of Google's growth is still dependent on their Google search division. So we'll take a look at this. This is Google's entire operating income over here. So you have YouTube around 15% of operating income. You have cloud at around 8% or so. Currently now, Google search as well as the subscription and services are at around 70%. So what that means is, in order for you to expect around a 15% EPS growth from Google, the entire business, assuming cloud grows at around 30-35% through margin expansion and through continual growth, assuming YouTube grows at around 12%, which is the normalized rate that it has been doing over the past few years, Google search has to grow at around 13-14% in order for the company to achieve around a 15% growth in terms of the entire business. So is it possible? Is it too high of an expectation? I think the valuation today is commanding this expectation in terms of growth. So if Google doesn't match that earnings expectation, then that could hit the stock price. So for Google today, I think the company is doing extremely well. And the only reason I would sell out of the company is simply because of opportunity cost. If there are better opportunities coming up, then I think Google is probably a trim to rotate to all those companies. I think at today's price, you are probably expecting closer to around a 10% CAGR over the next few years, unless the company comes up with something revolutionary like your TPUs, them challenging NVIDIA and so on. But yeah, I think in summary, Google is currently fully priced. I'm looking for opportunities. If those opportunity comes, then it is probably a trim. It won't be a sell. Company is high quality and the thesis hasn't changed yet. So for Google, that is what I'm doing with my position. Let me know what you think in the comments below. I'm sure some of you will say don't trim your winners, but this is a rational point of view that I'm coming up with. Next part, I'll be covering some of the holdings in my entire portfolio as well as what I view as attractive today. So this is my entire portfolio over here in terms of stocks. I've removed my cash position. It's currently around 25% of the overall portfolio for my entire net worth. I'm looking for opportunities to deploy, but not in this elevated US market. I'm actually looking at opportunities, deep value opportunities outside of the US with low correlation to reduce the downside risk for those 25%. But for this portion over here, I've actually added into some companies in this portfolio. So as you can see, Visa as well as MasterCard, they're currently around 20% of the entire portfolio. So how I view Visa and MasterCard as well as my future investments is as such. I'm trying to aim for companies with low downside risk and mid to high upside potential. So for Visa and MasterCard, they're relatively low in terms of their downside risk potential as compared to your AI companies that are currently trading at high valuations today. So Visa and MasterCard, that's the reason why they're currently now at around 20% of the entire stock portfolio positioning. So Visa is currently trading at, I believe, a 29 times normalized earnings. MasterCard is currently trading at closer to a 34 times. But on a free cash flow basis, MasterCard is trading at around 28 times price to free cash flow, which is relatively low as compared to its historical averages. I believe the last time it was this low was in the 2022 crash. So MasterCard today I view it as attractive. That's why I've been adding into this position. I think the bear case for MasterCard as well as Visa is around 10% growth, which is around 3.5% buybacks, that are free cash flow yield, around 3% inflation, that's around 6% returns already, and then you get a few percentages in terms of population growth as well as increase in terms of take rate and your digitalization and increased usage of cards. So the base rate is around 10%. Analysts are projecting around 16% growth for MasterCard over the next few years. Visa is closer to around 13%. MasterCard is the one that I'm more bullish on given the greater international exposure that the company has relative to which gives it more potential in terms of growth. So that's why I've added into these two positions. Next portion, I'll be covering some other stocks that I view as attractive in today's market. So the first company that is looking interesting today is Adobe. So Adobe is currently trading at a 20 times price to earnings, around a 14 times forward earnings. So year to date, the stock is down around 27%. And if you have to look at the numbers for Adobe, the numbers are all going in the right direction. So revenue is growing at around 10%, net income is growing at around 15%, EPS is also growing at this pace given that the company is doing a lot of buybacks. So from a fundamental standpoint, the company is doing very well. But from a qualitative standpoint, the company's narrative is not very good today because of AI innovations, like for example, Nano Banana, Sora from ChatGPT also. So that's the problem with Adobe today. But of course, they had an investor presentation where they said only 15% of the entire client base are casuals. So what that means is the remaining 85% are less likely to switch to AI products. The 15% might switch, so that's the revenue that Adobe might lose in the future if AI continually innovates at this pace. So the thing about investing in companies like this is you need to see if you can find a gap that the market is missing out on. So for example, for Adobe, the narrative today is that Adobe is losing out to AI. Adobe is not innovating in terms of AI. So the question is Adobe innovating? Is Adobe accelerating its AI innovation? So I don't think they're doing the AI portion yet. They're not spending money developing this model, so that's out. The second one is whether or not the AI division is growing fast enough to tune to the years of Wall Street. So currently not yet. The company is doing well in terms of its AI division. That's the part that I'm monitoring. That is a potential switch of narrative for the company. So in order for Adobe to turn out to be a good investment, your narrative has to change in the future. And I think for now, the only way for the narrative to change is for that AI number to continually grow over the next few quarters. And that's the number that I'm tracking for Adobe. Fundamentally, company doing very well, and this could be a potential value play if you're looking for a quality business with quality metrics. So the next company that is looking interesting today is Mercado Libre. So Mercado Libre is currently trading at a 50 times price to earnings, around a 40 times price to forward earnings. And year to date, the stock is down around, it's up around 22% in fact. So Mercado Libre is a company that is doing very well fundamentally. So revenue is growing at 35%, net income is growing at upwards of 45%. So fundamentally, the company is very sound. Qualitatively, however, I don't think the company has a very substantial moat. So the two moats of this company is number one, the network effects, which is more sellers leading to more buyers, leading to more sellers, and so on. It's a flywheel effect where the increase in the supply, the increase in the number of sellers actually makes Mercado Libre itself a better platform. So that is one mode for the company. The second mode of the company is the ability for them to have lower cost as compared to your traditional banks. So in Latin America, a lot of your traditional banks, they have extremely high client acquisition costs. So they have client acquisition costs of between $50 and $100. But for Mercado Libre, the digibank after all, so they can acquire clients at a much lower price as compared to all these other traditional banks. And that's why they've been stealing share continually over the past few years. That's what another company, which is Nubank, is doing also. So that's another moat for the company. So the current P ratio is still elevated. I think this could be an opportunity if you're willing to buy a company at around fair price. I think the company has aspects of the business that is high quality. But of course, it's not a compounding machine. So for this investment, it would be sort of like a moonshot investment, not so much a stable, low-risk investment like S&P Global, like Visa, like MasterCard. Last company in this list is Meta. As crazy as it sounds, I'm actually looking to increase my Meta exposure if the company continually falls. So Meta today is currently trading at a 21 times forward earnings. On a trailing 12-month basis, if you're to remove the one-time expense, the company is trading at around a 22 times price to earnings. So on an EV to EBIT basis, the company is trading at 19 times. And for Meta, the story is simple. The company is growing revenue very strongly. So your ad revenue is increasing at an exponential rate. You have net income growing quite strongly also. I think the markets are mispricing the fact that they're spending a lot of capex. So the market is punish Meta because they're spending a lot of capex, but the capex have returned massive ROI over the past few years in terms of revenue growth. So my thesis for Meta is simply the fact that the markets think that Meta is spending all this capex money for nothing. I think otherwise. I think Meta is doing very well in terms of getting ROI on the investment. The company has also said that they're spending this investment money on building out its existing suite of apps. And for example, your Reels have gone from $1 billion to $50 billion in terms of run rate. And they can do the same for WhatsApp also. So WhatsApp is another untapped portion of the business that the company hasn't explored yet. If they're able to basically pull the lever for that division, then this could be a revenue accelerator for Meta also. So for Meta today, I view the company as attractive. Hopefully this continually falls. My previous ad was at around $600 a share. I added at $650, then $600. Hopefully it falls a lot more so that I can get to my other buy prices as well. I hope you guys have found this video useful. Feel free to check out the Substack and invest safe.